Can the housing market possibly lose half of its value in 1 year in 2021? Is there a potential housing crash on the horizon? Well, here's something to consider. It's all about interest rates, and it's all about who is the buyer right now and who's driving the prices of houses. So what is spurring the demand for housing right now is low interest rates. Record, unbelievably low interest rates. The money's almost free. We've been under 3% for a long time now. So here's a couple things that can affect the value of housing. And as it stands right now, this is February of 2021. We are already seeing interest rates on the rise. They've gone up 3 times now already in 2021. So right now, everybody is conditioned to think that anything below 3% is normal, and that's a good rate. And if rates get above 3%, that's kind of a mental threshold now for people where they kind of lose interest in buying, and they really lose interest in refinancing because it just doesn't make a lot of sense for a lot of people in their loan situation because the rates have been so low. But here's the biggest factor to consider and to keep in mind about housing market and housing values with interest rates. For every 1% that the interest rate goes up, that affects the value of housing by 10%, pretty much across the board. Because people, for the most part, the biggest bulk of the buyers are people that need to qualify for a 30-year mortgage or a 15 or 20-year mortgage. So that's all based on their debt to income ratios, the payments they can afford, and a lot of people have a payment in mind because remember, right now what's going on, people are buying payments, they're not buying houses. So the values are in direct relation to the interest rate. So for every 1% the rates go up, that's going to affect the value of a house by about 10%. So if rates get up to 4 or 5%, that could significantly change the situation and drop housing prices 20, 30% in 1 year. And then it can get even worse because as the demand drops for housing, prices come down, and that could be a real problem, especially if there's distress out there or people that are behind on mortgages, things like that. In the forbearance program that comes full circle. Hopefully we won't see that situation and hopefully rates won't get that high. But here's the thing, interest rates are on the rise. The United States needs to issue more debt. There are other vehicles that the Treasury and the Fed are actually pushing investors into risk assets, Bitcoin, stocks, things like that. So there's other investments out there that are more attractive and are higher yielding investments for institutional investors other than treasuries. So when we have to issue more debt as a nation for the spending that we're having to do due to COVID, and we continue to issue more, we're going to have to offer higher rates to make it attractive to investors, which increases the mortgage rates. So you really want to keep an eye on rates, keep an eye on inventory levels, keep an eye on the news. The other thing to remember is like I said, everybody is buying, not everybody, but most buyers right now that's driving the biggest portion of the demand in the market, they're buying a payment. They're not necessarily buying the house. So you want to look at who those buyers are, what demographics are feeling the most pressure, and how interest rates are affecting the value of those houses in that purchase. And watch those rates. As they go up, prices will come down, and rates have gone up 3 times this year. They are going to continue to go up, and that is going to put the brakes on the housing market extremely fast, which is what triggered the 2009 collapse. It all started with interest rates rising, which collapsed the real estate market, which trickled through to the banks and created the entire financial meltdown. Now, the good news is that people inside the Fed and Treasury went through that 2009 time period, so they know what's at stake, they know what the potential is. The problem is with interest rates as low as they are, that's trickling through the entire economy, including the markets and everything else. So it's almost impossible for the Fed to let interest rates get but so high. But if we need to issue debt in order to pay for the spending that we're doing, we have to issue the debt out to the market, and that's either going to be bought by the government or it's going to be bought by investors. And if investors are going to buy our debt, especially if we're issuing more and more, they're going to want more yield on that. Rates are going to go higher. That's going to affect housing. So remember, for every 1% rates go up, that affects housing values by about 10%, relative plus or minus. So keep that in mind and watch out for the changes in the interest rate environment.